Welcome to the Fiducia review of investment markets during the past 12 months. I'm delighted to have Michael with us once again. Michael's our independent economic advisor. So 2013, Michael, how do we take stock of that, the events that happened?
Well, from an investor's point of view, it was a pretty good year. We saw equity markets rise by 20 to 30% in the developed world, and we saw economic growth gather momentum. Inflation was well contained, interest rates didn't really change, in fact quantitative easing was continued, and you had some big changes in Japan and China which went down well in markets. So the idea that you were paid to take risk was reassuring. We had put more risk into our portfolios from the summer of 2012 in anticipation that the economic news might get better and that markets would be re-rated. So that paid off in the context of last year.
So where does that leave us in terms of looking ahead into 2014?
Well, although we've got into the new year with arguably the economic news still looking good and people raising their expectations for growth and not worrying about interest rates, it may seem a little ironic that we are beginning to plan to take less risk. That the idea of being more cautious is a theme that we would look to be pursuing during the course of this year. Not rushing into doing it, but just giving notice that we think that there are two reasons why taking less risk might be more relevant. The first is that I don't think the growth momentum will actually be maintained into 2005 and 16. Now, you might argue, why is that relevant? Well, actually markets look out 2 to 3 years. So although we're going into 2014, there's no point talking about 2014. What you have to do is get a sense of what the markets will begin to think about in 2015-16. And the things that they will think about are that the imbalances in the global economy have not really been addressed, and hence that the austerity programs that we've had for the last 4 years or so arguably have to be maintained at the same rate for the next 4 or 5 years, and you need some structural reform to come through in markets that really need it, in Europe, in Japan and in China. Now, they have announced those changes in Japan and China. They will take time to come through, however, but we've not yet seen the full reform programs announced in Europe. So for a variety of reasons, we think that as we go through this year, the expectations for economic growth will actually deteriorate for the years to come. And the second thing that we're taking into account is the end of quantitative easing. The States is relevant for this because that has been the first and most effective, arguably, but they have already given notice that they are going to be reining in the amount of money that they're going to be putting into the economy. Now, over time, that will have a significant effect, because if you are still having to pursue an austerity program and you're not pushing monetary policy as aggressively as you were before, then markets will begin to worry about the consequences of those two developments. So as we go into 2014, our plan is at some stage to start to take risk away from portfolios.
I understand. But in terms of you were talking about quantitative, the tapering of quantitative easing. Do we have a view as to over what sort of period that's likely to run before we could get back to normality, if that's the right way to phrase it?
Well, there are two aspects of that. The first is, do they start issuing new money at a lower rate? Now,
Sure.
The States have given notice of that. Japan arguably is going to continue for a bit longer. Europe, to some degree, might need to do more, because to date, all they've done is put money into the banks, and they've now been recapitalised to some degree. They haven't had the bond buying programme that we have seen on the scale. We've seen it in the States and indeed in the UK. So Europe is again an outlier to this. But I suspect through the course of this year, you will see that the tapering programme will gradually decline. And by the end of the year, I think the markets will begin to anticipate a rise in interest rates. That's not to say that the official interest rate rise will come as quickly as this year, because if anything, I think the central banks are more inclined to be late to the party rather than trying to squeeze too early. But the markets which are forward-looking will begin to anticipate higher interest rates to come.
But that's got to be sort of offset and take account of the recovery, which is ongoing, but is having to be, well, take account of the, as you say, the austerity that's still trying to get rid of the deficits that the major economies still have.
That's right. And if you look out over the next 10 years, I know it's a long time to look at, but of the 52 largest economies in the world, only 20 are expected to grow more in the next 10 years than they did in the last 10. In other words, we are beginning to see a much lower growth environment for the global economy, partly because of the need to repay debts in the West, but also because of demographics. We now in the West have an ageing population. We've passed the sweet spot where the young and the old are starting to rise in numbers relative to those in the working population. And so that balance is quite an expensive one in terms of government support, but it also means that the underlying growth rates can't be maintained at the same level. So there's a danger when you have that corporate earnings can't grow as fast as they have been in recent years. And if interest rates aren't going to come down further, in fact starting to go up again, then the boost to profits that has come from interest rates coming down clearly can't be repeated. And if anything, that will go slightly into reverse. So I'm not suggesting that we have to run for cover or anything like that, but I'm suggesting two things. Firstly, that I think that the payment for taking risk, which was very high 2 years ago, isn't as high now, so why take as much risk? But secondly, the type of risks that you should take should change. So we're looking much more at exposure to real assets, property, infrastructure, particularly, because these are the ones that give you a hedge against inflation. They're ones where they're seeing real incomes rise in terms of property rents and the returns to infrastructure. We know there's a great need and demand for infrastructure, a great urbanisation programme going on worldwide. Half the economic growth of the next 10 years or so is actually going to come from the growth of new cities and the expansion of old cities. And that is going to be quite an important concept. So those two things in terms of real assets we think are quite important for the medium term. But in terms of taking risk right across the board, we're going to be much more selective.
So these are the themes that we're going to be following during 2014 and beyond in the Fiducia portfolios, in essence.
They are, and two other aspects. One is a continuation of what we did in 2013. We moved away from bonds to absolute return funds because we felt there were no real value in bonds. And even though we've seen bond yields rise, we don't think there's any exceptional value there yet. So the need to have absolute return funds and hedge funds is still important. And the other thing is that we've been much more selective in terms of our emerging market exposure. Yes, we buy into the emerging market story, but we've been trying to tap that in terms of overseas companies benefiting from exposure to emerging markets and being very selective in the areas within the emerging world that we're seeking to play. So it is a much more balanced, controlled risk portfolio that we're trying to put in place this year.
Michael, thank you once again. Really good to talk to you, listen to your explanation of what's happening. So thank you again.
Thank you, John.